This presentation is on the risk and term structure of interest rates. I'm Pat Obi, Professor of Finance at Purdue University, Calumet. This first section, though, will deal with the risk structure of interest rates. And by that we mean why bonds with the same maturity have different yields, different interest rates. And we find that the risk characteristics that will cause the interest rates on bonds with the same maturity to be different would be due to one or more of these three factors. The default risk differences, in other words, bonds with different credit risks. And two would be the liquidity risk differences, which speaks to how easy or not so easy it is to resell a bond in the financial markets. And finally, the income tax differentials across different bonds. And so we're going to look at these in turn. First, default risk differences. And as I mentioned, default risk is credit risk, which is the risk that the issuer of the bond, that's the borrower, is unable or unwilling to make interest payments when those interest payments are due, or for that matter, pay back the principal at maturity. And so the default risk premium on a bond would be the spread between the interest rate, the yield, on a default-free bond, on a bond that has zero credit risk, and the interest rate or yield on a bond with default risk. So to get this, to show this a little better with an illustration, consider a bond with zero default risk. And let's say the interest rate on that bond is at a point such as this. So this yield right here is a yield on a risk-free bond, on a credit risk-free bond. And so if it is true that as the default risk of bonds increase, their yields also rise, then the difference between the rate on this credit risk-free bond and the yield on these other bonds would define what's called the default risk premium or credit risk premium. Well, how do we determine the default risks of bonds? Well, you may have heard of bond credit ratings. So these credit ratings provide an indicator, serve as an indicator of the credit worthiness of a bond issuer, of the borrower. And that borrower could be an individual or a corporation or a government entity. For individuals, if you recall, here in the United States, we have three major credit companies that provide credit scores for individuals, and they are Experian, Equifax, and TransUnion. Now, for corporations, as I'm going to show, there are also three major rating agencies. And so the credit ratings that they provide informs potential lenders of the likelihood of borrower defaults. So here I show you the conventional corporate bond ratings provided by the three major corporate and government bond rating agencies, Moody's, S&P, and Fitch. Now their ratings are pretty comparable. However, what I've done here is to draw a line, a thick line right here, showing that bonds with credit ratings above this line for any of these rating agencies their bonds would be considered investment grade. In other words, there's a high likelihood that the lender would get paid. However, if the rating is below this thick red line over here, then we refer to those bonds to be non-investment grade, aka junk bonds or high-risk bonds. So obviously, the greater the rating, the lower the default risk, and therefore the lower the interest rate would be. At the top, though, would be treasury bonds that carry a rating considered to be above AAA. And for empirical studies and various practical purposes, we typically use the interest rate on U.S. Treasury bonds as risk-free bonds, not considering inflation though. Alright, so what I've done here is on this date, September 16th, 2015, to identify the yields on various bonds with different credit ratings, at the top of which is treasury bonds. But for us to do this, we have to isolate maturity. So these are all 5-year bonds, and 5-year treasury bonds are selling to yield 1.59%. Next in line would be AAA corporate bonds. With, again, they all have the same maturity, and you can see the yield to maturity here is 1.96, and so there is a default risk premium of 0.37, the difference between these two, right? That marks the credit risk premium, the yield difference. And next in line would be AA, yielding 2.21%. And again, you can see that the risk premium between the AA and the AAA is 0.25. If you take the difference between 2.21 and 1.59, then you'll get the credit risk difference, or the default risk premium between the AA bond with respect to the treasury bond. And finally, single A. All right, you can see that. So for you to kind of see how that works, let's go here. Yahoo Finance is a good site to go, and here we have treasury bonds, their maturities and their yields. But again, remember, we're looking at risk differences. So let's look at these. For us to do so, we're going to have to isolate the years. So for example, 5-year AAA is selling to yield 1.95, and then you look at 5-year AA, you can see it's a little higher, 2.21. You look at 5-year single A, and it's yielding 2.53. So this is how you look at it. You can't mix and match the maturities. You got to leave the maturity to be the same. Now, interestingly though, you find that 5-year AAA for municipal bonds right here is yielding 1.43, which, as you can see, is less than 5-year AAA corporate bond. 1.95 is less than that. In fact, if you compare this to 5-year treasury bond, which is 1.6, you find that this municipal bond is 1.43. How is it that a municipal bond has a lower yield than treasury bond, which is issued by the United States government and is backed by the full faith and credit of the federal government? How can that be? Well, we'll get to that point in short order. All right. In the meantime, what I show you here is what happened on August 5th, 2011, which is the day that S&P downgraded U.S. Treasury bond. Not necessarily an account of the United States saying that it wasn't going to honor its debt securities, but rather an account of fights, brinkmanship, so to speak, between President Obama and the Republican Congress. The Congress wanted presidents to cut spending a little bit more than the president wanted to, as a way to balance the budget. On the other hand, the president wanted to raise taxes more so than the Republicans wanted to deal with. And as a result, there was no budget agreement, and in response, the S&P downgraded U.S. Treasury securities from down to AA+. That, in the views of many, is quite symbolic, because as you can see, more than substantive, because as you can see, the thick blue line here shows you the trend of corporate AAA bonds yield going forward. The thick green line here is U.S. Treasury bonds. And of course, this is the financial markets, which, by the way, in the years that followed went everywhere but up. But anyhow, but the thick blue line here is a line to watch. So you can see that after the announcement of downgrade was made, actually the market didn't really think that was a serious issue. The yield on U.S. government bonds actually went down, as you can see, and stayed quite low in the many days, and as you might already know, years to come. So that really didn't have any punch to it for the most part. And some ways that credit derivatives can be managed could be the use of credit swap. which is a swap contract where two or more lenders agree to exchange their interest incomes expected on their bond investments. So as a result, you're able to kind of reduce the risk of not receiving a particular interest income if the borrower defaults. Number two, though, which came into the limelight during the 2008 financial crisis, is credit default swap, which is a swap contract in which the buyer makes premium payments to the seller and in exchange receives a payoff if a bond goes into default. So to make you fully understand this, I provide this illustration. This is my doing right here. Hopefully you enjoy this funny story. So we have here Joe Homeowner. That's his name. He takes out a loan of $400,000 from this bank right here, right? And the loan officer is Mr. Jeff Bank. And so this guy is going to buy this lovely home, but afraid that Mr. Joe Homeowner may default on this loan of $400,000. Mr. Jeff Bank, representing this big downtown bank here, goes ahead and purchases a credit risk insurance from Mr. John Gia. If you kind of flip these letters, you might get the message as to which company I'm referring to. Anyhow, so Mr. Bank purchases credit risk insurance called a credit default swap. So he, in essence, is the CDS buyer, credit default buyer, and Mr. John Gear is the credit default swap seller. So what happens in essence is if Mr. Homeowner were to default on this loan, then Mr. Bank would file a claim with Mr. Gear and get paid $400,000. So as you can see, the likelihood of a claim being filed would increase if this guy, Mr. Homeowner, increasingly becomes less likely to pay his loan when they are due. Now, for good measure, as became evident during the financial crisis, side bets can be placed on this particular instrument. In other words, you can buy and sell CDS whether or not you have a direct claim on the property or on the loan. So we can have this individual here betting with this guy to say, hey, if this guy defaults, you're going to pay me. And this guy says, well, if this guy doesn't default, you're going to pay me. And so by placing this side bet, they can create a much larger market for CDS in the financial system, which is exactly what happened, because in 2008, trillions of dollars in credit default swaps were traded. And they weren't quite regulated. And that's as a result of the Commodity Futures Modernization Act of 2000 that enabled these trades to not be recognized, to not be regulated, and to be and not to be considered as conventional insurance. Which, if you sell a conventional insurance, then you have to provide loss reserves. Back to this. You can also purchase total return swap. For example, two parties may enter into a 1-year total return swap where party A would get paid LIBOR plus 2%. LIBOR is London Interbank Offered Rate, which is a short-term interest rate that changes pretty much by the day. And then party B would receive a total return on the S&P 500 of the S&P 500 on the principal amount of, let's say, $1 million. So now this is how it works. Let's say that LIBOR is 3.5% on a given day, and on that day S&P appreciates by 15%. Well, during that term, what happens is party A that receives LIBOR plus 2% will then receive 3.5% plus 2%, 3.5 being LIBOR plus 2% for a total of 5.5%. And this party A will then pay party B 15%, which is the return on the S&P 500. So let me repeat. So if during the term LIBOR is 3.5 and S&P appreciates by 15%, party A, which is the guy in red right here, will pay the counterparty 15%, which is what he or she has promised to do, 15% of $1 million, and receive 5.5% of $1 million. 5.5 again being LIBOR of 3.5 plus the fixed rate of 2. So the way it works is that the payments will be netted out at the end of the swap term, with party B receiving a full payment of the netted payments of $95,000. So that means $15,000 that party A would pay minus 5.5% that party A will receive. So that means that party A is paying 9.5% more. So that 9.5% multiplied by $1 million is $95,000, which party A unfortunately would have to pay to party B. But all of this is done as a way to mitigate the likelihood of default on some underlying loan. So this serves as some type of insurance. And then there's credit default option, another derivative. An option to buy protection called a pair option can be purchased. So also is an option to sell a protection called a receiver option, and that can be done as a CDS on a specified bond with a specified maturity to the contract. So in general, remember, an option is exactly what you've called it. It's not an obligation. So for example, if you have a pair option which gives you the rights but not an obligation to buy protection, it means if you are a lender and you lend, say, $100 for 1 year, as the year rolls around, if the guy who borrowed the money from you is increasingly less likely to pay back the loan, you can decide then to exercise your payer option and buy a protection. But if through the period, through the loan term, the borrower remains financially strong and you have no fear that the guy would default, then you can simply let this option elapse. You can let it expire. That's how that works. So, and then another reason why there could be risk differences is on account of liquidity differences. Again, liquid asset is one that can be sold easily and quickly without incurring much cost. So the more liquid an asset is, the more desirable it is, and therefore, all things equal, the easier it is to resell that asset in the financial markets. An example of such an asset is U.S. Treasury securities. But the less liquid an asset is, the less likely it is to resell in the market. And so for such less liquid assets to sell in the financial markets, we're going to have to pay, the lender would have to fork out a much higher interest rate. So that higher rate serves to compensate for the liquidity risk, higher liquidity risk problem associated with that asset. And then finally, income tax considerations. First of all, there are certain bonds that require different tax payments on the same amount of income. But more directly, interest payments on municipal bonds in the United States are exempt from federal income taxes. And so what happens is that if you buy a municipal bond that pays you 5% per year, that 5% is for you to take home and enjoy fully. No taxes paid. But to remind you of how this works, I remind you here rather of a little bit of income of bond valuation. Let's say we have a bond with a face value of 1,000, coupon rate of 10%, maturity of 5 years, and say the investor is in a 20% tax bracket. So now he's going to get annual income of $100. Since he's in the 28% tax bracket, he's going to have to pay tax to the government equal to 28% of this $100, which is 28. So what he has left is $72, which is 100 times 1 minus the tax rate. This is the investor's after-tax income. Now, on a percentage basis, it's going to be the coupon rate of 10% expressed on an after-tax basis. So this yield, the after-tax yield here would be 7.2%. So now, let's say that we have a municipal bond. For this municipal bond, Coupon rate is 8%, but this bond pays no taxes. So your entire $80 is for you to go home and enjoy. And therefore, your rate of return on this bond, which is your after-tax yield, would still be 8%. So there's something that needs to be shown here, and that is, if you purchase a municipal bond, for example, with a yield of 7.8%, remember this 7.8% is your take-home pay. It's an after-tax income since you pay no taxes. So if you are in the 28% tax bracket, the only way that you can compare this yield to the yield of a taxable bond would be to calculate the pre-tax yield. To calculate the pre-tax yield, remember this is the after-tax yield we showed earlier, which is your rate multiplied by 1 minus t. This is your after-tax yield, your RAT. So if you want to calculate your before-tax yield, R, or pre-tax yield, then solve for it algebraically, and that's going to be your after-tax rate divided by 1 minus t. So if the yield on a municipal bond is 7.8% and you are in the 28% tax bracket, what the yield would be on a before tax basis is 10.83%. Therefore, if I may go back here to the financial pages where 5-year municipal bond is yielding 1.43% and 5-year treasury bond is yielding 1.6%. This 1.6% is a before tax yield, but this 1.43% is an after tax yield. So let's take this 1.43% and place it on the same pedestal as this 5-year treasury bond. To do so, if you're in the 28% tax bracket, you'd have to divide this 1.43 by 1 minus 0.28, which should come out to about 1.99%, something like that. So as you can see, when you express this on a before tax basis, you're going to get a yield 1.99%, which is clearly higher than 1.6%, reestablishing the underlying fact that yes, treasury bonds have a lower risk than municipal bonds and therefore pay lower before tax yield than any other bonds out there. Alright, so a little bit of a take-home footnote here. In 2001, President George W. Bush signed a law. I guess I should be careful with my grammar there. Alright, signed a law reducing the top tax bracket from 39.6% to 35%. This will stay over 10 years, and then at the end of which Congress will review it and possibly renew or just leave it as is. So this was one of the measures that President Bush took to contain the 9/11 era recession when he came into office. So now I note here, I'm not going into the political aspect of it, but the financial aspect, because this legislation reduced the tax advantage of municipal bonds over treasury bonds and corporate bonds. And the reason is because interest income, as I note here, on treasury and corporate bonds was taxed at a lower rate for high income investors. So as you can see, if you are paying tax on your bond at 39.6% and then your tax rate drops down to 35%, which is a good thing, but keep in mind that it'll make municipal bonds increasingly less attractive to you, because if the tax that you're going to be paying on other taxable bonds has gone down, then why the heck would you care so much about tax-free municipal bonds? Which the reason municipal bonds are tax-free is to make it easier for local governments to borrow and finance their fiscal priorities. So that's just the financial implication of tax reduction. Repealing the Bush tax cut meant that the advantage of municipal bonds would go up again relative to treasury bonds and corporate bonds. Because the higher your tax rate, then the more attractive municipal bonds would be to you, because you're going to say, hey, why would I want to pay tax of almost 40% when I can buy a municipal bond and not pay any taxes at all? Assuming that the lower yield of municipal bonds is still attractive enough to you after you have made the adjustments I've just shown to pair everything up on a before tax basis. And now the final giveaway here is that on January the 1st, 2013, in a deal between President Obama and the Republican Congress to avoid budget sequestration, which is the automatic spending cuts, the top marginal tax rate was restored back up to 39.6%. And we're going to end this introductory lecture at that.